Ancient Mesopotamia, the land between the Tigris and Euphrates rivers, was one of the earliest places on Earth where organized lending and borrowing became part of everyday life. People living in the cities of Sumer, Akkad, Babylon, and Assyria depended on farming, trade, and temple-based economies, so money and credit were essential for survival. The surprising part is that interest rates were extremely high by modern standards, often reaching around 30% a year. But even though these rates sound harsh today, people in Mesopotamia willingly took these loans because they lived in a system where borrowing was not a choice. It was a necessity built into the structure of their society. Life in Mesopotamia was full of uncertainty. Crops depended on river flooding, irrigation canals, and unpredictable weather. A single bad harvest could push a farmer into hunger and debt immediately. Most farmers did not have large savings, so when they needed seeds for planting, tools for repairing irrigation canals, or food to survive until the next harvest, they had to borrow. The high interest was accepted because the borrower had little bargaining power. Without the loan, there would be no seeds, and without seeds, there would be no harvest at all. In other words, the risk of not borrowing was greater than the burden of high interest. Agricultural loans were usually taken in grain or silver, and farmers believed they could repay after the harvest. Even if the interest was high, the loan gave them a chance to survive another year and keep their land productive. Another major reason people took such expensive loans was the power held by temples and palaces. In ancient Mesopotamia, temples of gods like Marduk, Ishtar, or Inanna were not only religious centers, but also economic institutions. They owned vast lands, controlled food storage, and acted as early banks. Temples lent grain and silver at fixed interest rates that had been part of the legal and economic system for centuries. These rates were not negotiable. They were part of tradition, recorded in legal tablets and enforced by the authorities. When people needed money, they did not walk into a competitive market. They had only a few major lenders, temples and wealthy merchants, who all charged the same standard interest. So borrowing at 30% was not seen as unusual. It was simply the way the system had always worked. Merchants and traders in Mesopotamia also took loans despite high interest. Long-distance trade was risky but profitable. Caravans traveled to Anatolia, the Indus Valley, Egypt, and the Persian Gulf carrying textiles, wool, metals, and luxury goods. If a trader needed money to buy goods for a journey, he would borrow silver from a wealthy lender, promising to repay with interest once he returned. The journey was dangerous, but the profit could be large enough that even 30% interest did not discourage him. In many cases, the lender also shared the risk, and if the goods were lost due to bandits or storms, the interest would be forgiven. Because of this, traders saw high interest as a business expense, rather than a burden. Ordinary families also borrowed for emergencies such as weddings, funerals, medical needs, or sudden taxation. Mesopotamian authorities taxed households to maintain irrigation systems, city walls, and military expenses. If a family could not pay taxes on time, borrowing was the only option. The interest was high, but taxes were unavoidable, and penalties for not paying could be even worse. For many families, the choice was simple: take a loan, pay the interest later, and avoid punishment. The loan allowed them to keep their status in society and protect their homes and land. Another reason people willingly took high-interest loans was the legal and social system that allowed debt forgiveness. Early Mesopotamian kings sometimes declared cleaning of debts, known as debt amnesties, or economic resets, especially after disasters or a change in the throne. These royal decrees erased many personal debts, freed people from debt slavery, and returned land to families. Because people believed such amnesties might come again, they were less afraid of borrowing. Even if interest accumulated, there was always a chance that the king might cancel debts to restore stability. This created a strange balance, where lenders still charged high rates, but borrowers hoped that political events could wipe away their obligations. High interest rates were also tied to the risk faced by lenders. In a world without modern insurance, banking systems, or government guarantees, lending was dangerous. Harvests failed, caravans were attacked, and borrowers often could not repay on time. To protect themselves, lenders demanded high interest to balance the risk. If 3 out of 10 borrowers failed to repay, the interest from the remaining borrowers needed to cover the losses. This system made lending profitable, but also kept interest rates consistently high over centuries. Silver and grain, the two major forms of currency, added another layer of complexity. Grain loans were common because grain could spoil, be eaten by pests, or become worthless after a bad harvest. Silver, on the other hand, was stable but rare, so lenders valued it highly. Because silver could be easily transported and used anywhere, loans in silver demanded higher interest. Borrowers accepted these terms because silver loans gave them greater purchasing power in emergencies and trade. Despite the harshness of the system, borrowing was deeply integrated into Mesopotamian economic life. Families, farmers, merchants, and even small craftsmen considered debt a normal part of survival. People preferred to borrow and risk high interest rather than fall into famine, lose their land, or miss economic opportunities. Debt could be dangerous, but it also kept the economy moving and allowed cities to grow, armies to function, and trade to expand across the ancient world. In the end, people in ancient Mesopotamia borrowed at 30% interest because the entire structure of society depended on credit. Loans allowed them to survive unpredictable harvests, maintain their homes, support trade, and meet the demands of the palace and temples. High interest was not seen as exploitation, but as a normal and necessary part of life. The system may seem harsh today, but in a world without modern financial institutions, it was the only way people could manage risk and keep their communities alive.